only and must be construed as a personalized trading recommendation. Any expressions of opinion that either of us make could change at any time based on market conditions. We look at a lot of charts, but we do not recommend the use of technical analysis as your sole means of investment research. We evaluate markets with ETFs. Finally, we look at futures contracts. If you're going to trade those, do read the risk disclosure document for futures and options. And with that, I'll put up the heat map and we'll review the news. And if I miss anything, Mike, just chime in.
Will do.
All right. So anyway, starting overseas, Beijing is relaxing some restrictions to allow more foreign carriers to fly to the mainland after Washington yesterday retaliated against China's curbs on U.S. passenger airlines by barring Chinese airlines from entering the U.S. effective June 16th. The new regulations that Beijing is looking at as qualified foreign carriers who are currently prohibited from operating any routes into China will now be able to have once-a-week flights into the city of their choice starting June 8th. We had the ECB decision, no change on rates, but we did get some stimulus there. They are doubling the size of their pandemic emergency purchase program for the bonds over there from 750 billion to now 1.35 trillion euros. Also in the Eurozone, Angela Merkel's governing coalition surprised the markets a little bit, going past the upper limit of what they said they were going to do for stimulus. They are now considering 130 billion euros of stimulus. That exceeded the top end by 30% because the other numbers were to say they were going to just do 100 billion. So what happened when those news came out? Well, stock futures were down overnight. They rallied after the ECB news, but they turned back after our jobless claims came out, which were a little bit higher than expected. The specific numbers, initial claims for the week ending May 30th decreased by 249,000 to 1.877 million. The consensus was for about 1.8. And the market sold off a little bit. Then it rallied, and then the market is showing a little bit of weakness now as there's a report from the White House that discussions regarding the next stimulus package have been delayed. So that's why we're getting a little bit of red on the screen right now. That's all I've got, Mike. If you want anything, or let's take a
Well,
look.
we do have the payrolls report out tomorrow. It's definitely a decline from the 20.5 million we've seen last month in April, but we're still looking for, I'm hearing anywhere between 7 to 8 million jobs being lost here in May, and the unemployment rate expected to tick up to possibly as high as 19%. So it's definitely really some sobering figures there as well too. So we'll definitely take a look and see what they say tomorrow at 8:30 Eastern.
All righty. All right, what do you want to look for as far as futures?
Well, let's take a look at the gold market here. So let's look at the August gold, GCQ20. And what we're going to look here, as soon as we bring up the chart here, is that we've had, once again, another successful test of that 1700 level. We broke below it yesterday, closed above it, and today we had a small test and once again rallied off that number. So I think we're at a pretty critical junction. In fact, given that the weakness we've seen in the U.S. dollar the past several sessions, I would expect this gold to even be up a little bit more today. So that's maybe even a little bit disappointing, even though we're up a little bit over 1% today. But if you are long gold here, I would definitely look at yesterday's lows, which came in around just a little bit above 1690, and it might be a place to maybe start tightening up a stop here. Maybe give it a little room below the lows, maybe down to even, you know, another $5 to $8 below that in case you get a little slippage there. But I would want to kind of tighten up my stops at this point here, because I'm feeling if we can close below that 1690 level, then and get below even like 1683, then there really isn't much downside there for quite a ways that I could see. So yeah, definitely time to be cautious here if you're long gold. However, should we hold those lows from yesterday though, then yeah, the market could probably get to the upside. That 1750, 1755 zone as we kind of remain range bound here as well too though. So yeah, definitely time to maybe tighten up the stops here and see if we could hold these recent lows. But yeah, I was expecting gold to be a little stronger today given the weakness in the dollar. So that's why I'm getting maybe a little bit nervous here about this rally near term. Let's look at a market though that we've seen a bit of a breakout though. Let's look at the soybean market. Let's look at July soybeans, SN20. This is another
Oh,
market that has been range bound, and we had a nice little breakout today. So, and I think a lot of that is it's going to be a common theme here is tied to the weakness in the U.S. dollar. Uh, a weaker dollar makes U.S. Commodity exports more competitive, and we've actually seen a rebound there in the value of the Brazilian real, and Brazil is a major competitor to the U.S. in soybeans. So a stronger real there was actually going to kind of benefit U.S. producers here. So I think that's probably the reason why we're seeing this breakout here. The market commodity funds have turned slightly net long on soybeans as well too. So now we got this breakout above the this kind of zone we've been in here, this, you know, was a 25, 30-cent zone we've been in for quite some time here as well too. You may get that momentum buying on the upside. Upside target though, we got to look back at that. I think it's the April 13th highs there, which is just a little bit above today's levels here, come around 877 and a half. That's probably your next resistance. And if we can get through that though, there's really not much on the charts there until like the 888 to 890 level, and then above that we got 900 of course in the pictures. So after this nice long consolidation on relative low volume, I think we may see a little bit of a pop here in the soybean markets. If you are long in this breakout though, I definitely want to have a stop probably somewhere below that 10-day moving average, which is around that 847 zone, so maybe around 845 or so, in case a little bit of a range there as well. So I wouldn't want to see it go back below that 10-day moving average. Let's look at the Canadian dollar next, CDM20.
you said N or M?
M as in Mary. And let's look at that here. Now, here you notice that we're approaching the 200-day moving average. With this weakness in the dollar, we're seeing a lot of the currencies start to rally, such as with the Australian dollar we looked at last week has continued to move higher. Same with the euro currency, and now the Canadian here is testing that pretty key technical level there, which is around 74.40 here. A move above that, and we would look at that chart gap that we had back in early March there as well too. That would fill in, and that fills in. Let's see, around 74.40 or so. So pretty close to that 200-day moving average here. So that's definitely your area to watch. Above that, we'll probably get 75, and we got a lot of consolidation there between 75 to 75. 50 to 60 there, so it's going to probably take a little bit of a rest at those levels to move it higher there. But break above the 200-day moving average will turn the momentum traders long the market. Should the 200-day moving average hold though, we could probably move back down to probably as low as 73 if we don't see a little bit of support come in the market at the I would say look at probably maybe Tuesday's lows around 73.61. If we can't hold that, then 73 is probably back in target for the Canadian dollar. And finally, let's wrap it up with crude oil here, CLN20. Well, the market's holding up fairly well here. Once again, the EAA data, we had a draw in crude oil, a little over 2 million barrels last week, but probably more importantly, we had another draw in Cushing, Oklahoma of 1.8 million barrels. So the storage issue there seems to be kind of falling by the wayside. Products were a little bit bigger built in both gasoline and distillate, so that was kind of maybe a weighing on the market, but you got to say this market is continuing to track higher. If I was long the crude market here, we do note though we're seeing a little bit of a possible divergence during the RSI, so maybe a little bit of a pullback or consolidation is probably due for those traders who have been long. Maybe looking for a stop below the 10-day moving average around that 35 area or so. If you want to kind of tighten up your stops there as well. Though, to me, I think that chart gap there that we see back from March 9th there, to me, I think that this needs to be filled at some point. And it wouldn't surprise me if we can get maybe OPEC could come to some sort of an agreement and they could actually get some of their other members, primarily Iraq and Nigeria, to actually comply with their cuts. We could see that chart gap get filled up just above the $41 level. So, Lee, I'm going to turn it back to you.
All right, so a couple of questions. You gave us the level on the gold future. There's also a question, the gold index. We weren't looking at the gold index, we were looking at the gold futures contract. And the symbol on that is GC for gold COMEX. And then the current month is
August.
Yes, Q, and then the year 20. So that's the symbol for that one. And then we had a question about the silver.
Oh, let's take a look at silver. We can look at SIN 20.
And the specific question is just a pullback or something more serious? I think you'd have to, I mean,
Yeah,
to me, like the 200-day is as long as we hold that, we're okay.
I agree. Yeah, right around that $17 level. So yeah, this just looks like just a bit of a pullback so far. Obviously, if we fall through 17, then and there's not much there until almost down to $16 either. So it's a little bit of a support around 1650, but yeah, it can fall pretty fast when silver starts to turn around. This is actually probably a key point. Notice that the RSI is also from overbought levels down around that 50 zone here. If I was long silver, I want to see that start to turn up from here. And if we can get a little bit stronger move here, but like I said, the weaker dollar should help silver as well too. So if this is just the end of the pullback today, we see a stronger market tomorrow, then yeah, then maybe this was just a little bit of a correction here in silver.
Yeah, and I think you could have said that maybe we'd pull back a little bit. We had a very good RSI divergence at that last high.
Absolutely.
So that, it doesn't mean there's a change in trend necessarily. It just means that the momentum may recede just a little bit. Here's another question for you, Mike. Is there a mini soybean contract?
There is. The symbol is Y as in yellow, K as in Kevin, and right now the lead month is July. So YKN20 would be your lead month, and this is there's a little problem with it on the charts though. Sometimes you can't get the minis on here, but it charts pretty well with the regular soybeans. That is the last of the major old crop contracts. There's an August contract, but that's kind of thinly traded. If you're looking for new crop soybeans, it'd be YKX as an X-ray. That's November soybeans.
All right. Let's see. Then we had a question for a stop level. We talked about the futures that on gold here. The GLD, I would have to say it's at 157-ish.
Yep.
157.50. All right, let's take a look at our bond signal. Question on that. So first,
we're starting to see rates start to turn up a little bit here.
Yeah, we got a cross. Looks like. Yep. So this would be we're done with this trade then. I can actually put an arrow on this chart. So let's do that. Of course, assuming it closes here, but
right.
Make it a red arrow. So this was the last buy. This was a sell. Not a bad trade.
Not at all.
Uh, yeah. So interesting. So actually, I'm almost glad that that's happening because look at the move up on the 10-year. We broke out of this range maybe. Couple of things there. It should help the financials, and also maybe the bond market is finally buying into this, increasing activity. Maybe. What do you
It
think?
could be. Absolutely. I mean, we're starting even some anecdotal evidence. I mean, we're hearing some of the some of the companies starting to talk about how there's that pent up demand, and as the economy starts to reopen here as well too, maybe we were getting maybe a little over dour in our assessment about how quickly things can resume. So I guess we'll have to see how that plays out. But definitely the bond market there and the dollar there, all that stimulus coming in are starting to kind of play out. So we're actually starting to see maybe started some interesting trends coming on in a lot of these markets.
Yeah. So let's look at some foreign markets, the ones we've been following. Let's take a look at the EEM. Got a question on it too. Just a little bit of a pullback after this nice breakout. I think the trend is still up here for sure, and it's getting help from the dollar weakening. Emerging markets generally trade opposite to the dollar, so yeah. Key level here, if you're long for the longer term on this, is 37.90, right in here. But I mean, you
Should
can't
note as
expect
well too, if you
it.
put the 200-day moving average on, it stopped right at the 200-day moving average yesterday.
Yeah, that was a logical place. We actually said that yesterday too. Maybe if you had it, take a little off, but still a bullish chart. But that, when you go into resistance for the first time, it's not necessarily a bad idea to take just a little off the table. You can always buy it back. Either if it goes down to a support, which this would be the 10-day moving average, but your first support as it starts curling up, or if it breaks back out again, then add the portion that you sold. Okay, let us look at, we've also been following, for the reasons we've gone over and over, the Euro stock 50. We told you all about this one. Again, it's second time it hasn't been able to get above the 200, so maybe you want to take a little off the table. We've had a pretty good run since the breakout we pointed out, which was here. Wouldn't hurt to take a little bit of profits, but again, the trend is still up. We had a question on copper, Mike. So let me
Sure, July copper.
Yeah, so that's back in your valley look there. So that's HGN20, right?
Yep.
We
Well, right now it looks like that 250 is definitely acting as a resistance here. As you can see, it's a couple tests here, but honestly, it still looks pretty good to me overall. And right now we saw even today's little bit of a pullback there. It tested a 10-day moving average, and we kind of rallied up from there as well too. So my feeling is this market's maybe is going to consolidate around here. Maybe was trading between 250 to 240 for a little bit, but unless we fall below 240, though, I got a feeling the next target there is that 200-day moving average once again around that 257, 258 zone as well too, as this market has been just a very quiet, very steady up move, and really unless we take out 240, and if I was long copper, I would have a stop just below 240 there, that 20-day moving average, in case we do get a little bit of a pullback more than I expect.
Interesting. We got a question on the FEZ. What does it trade on basically after the European markets close? Well, supply and demand here in anticipation of what might happen the next day, pretty much. But I think the movements kind of, are a little bit less after the European markets close. But certainly a lot of the European stocks in this are big. They can also trade as ADRs. So over here. So it's some of that too. Okay, let us look now at the S&P. So a couple things I want to point out here. We are right at resistance. couldn't get through it. Again, you're right at resistance. You had a huge run up. It wouldn't be the worst case to take a little off the table. The trend is still up though. You could certainly hold on, maybe get a pullback to 200. But the other thing I'm watching, and maybe you want to put this on a watch list, is I'm going to show you a chart here. All right. Watch this level on the VIX. This was the low, and then we bounced off of it last time. That's what started this decline. So look to see if the VIX starts, if it can't break this 25-ish level, then maybe that'll suggest a little bit of a pullback. Right now, it didn't break it. Obviously, if it breaks it, then that would be more of an all clear on the market. But you're at resistance and you've got the VIX at support. This tells me if you've enjoyed the rally, maybe you take just a little off the table. Let's look where the VIX, that was a daily chart. Let's take a look at the intraday chart here on the VIX as far as where it is right now. This is that same level that I told you about on the other chart. And right now, a key level. So if it starts bouncing here, that would suggest maybe taking a little more off the table in the very short term. So I thought that was kind of interesting. This is the last test of that support. You can see we bounced right off of it, and that caused the market a little bit of a hiccup. So definitely watch that level. It's about 24.25 on the VIX. Okay, let's put the S&P back up there. If you're trying to set levels, you got the 200, you got the 10 for shorter term. Let's take a look at the 20. Whoops. 50 is not really in play. I think it's the 200 you got to watch if you're doing moving average analysis. I also wanted to just talk a little bit about the speed of the advance. So let me just pull up some data here. Okay. I have a fat finger there. Sorry about that. So we have had basically the S&P is up 39% roughly in 50 trading days. That is the strongest move for that index since 1952. Remember, 1952, we went to a 5-day trading week. Prior to 1952, the New York Stock Exchange was open on weekends. I don't know if you knew that, but
I did not.
Yeah, absolutely. So there have only been in history 2 prior 50-day moves of 30% since we went to a 5-day trading week in 1952. That was October 1982, which was right before the big secular bull market took off, and May 2009. Those 2 short-term spikes did turn out to be the beginning of multi-year bull markets. Just put that in there. Now, to do a little bit more analysis, since it's only twice that we've had that, if you decrease the parameters a little bit and just look for 50-day surges of 20% or more, there's a few more data points to review. So I'll just tell you what happened in the times we had that. Okay, February 1975, a 20% change in 50 days. 6 months, the market was up 5.6%. 82 we talked about, that was the beginning of the secular bull market. The 50-day change was 21.6%. 6 months later, the market was up 16%. March 26, 1991, the percent change in 50 days was 20.52. Market was up 6.4% over the next 6 months. 12/17/1998, market was up 21% over a 50-day period. 6 months later, the market was up 14%. The last 2 times in 2009, May 5th, the market was up 22%. In 50 days, the market was up 9%. Excuse me, 15% 6 months later, and then another signal on September 16th, 2009. Market was up 21% in 50 days, and the market was up 9% over the next 6 months. So we'll have to see if history repeats itself. But anyway, just kind of interesting. So we might have a little bit of a pullback here, but that shows that this kind of thrusting move generally has continued, would have to say. All right, you seen anything on the S&P that you want to point out here, Mike?
No, I think you nailed it right there. That was at the those levels there. You know, it's pretty significant resistance here. So it's probably no surprise that we're having a little bit of a pullback here, especially going into jobs data and the weekend as well too. So, but yeah, overall the trend is definitely still up. So, you know, a little bit of pullback may not be a bad thing. Maybe take a little bit of this overextended rally we've seen the past week or so and just find a little bit of a base of support here. So
Now, for you newcomers, it is Thursday. If you're a regular, you know what Thursday is. What is Thursday, Mike, on the market?
it is Sentiment Thursday.
That's right. So let's review the sentiment figures. Bottom line is they are getting, the bulls are getting a little bit more active, but we're not at danger levels at least yet. So let's start with, we do basically smart money, dumb money. We do the newsletter writers from Investors Intelligence, and we do Ma and Pa, if you will, from the American Association of Individual Investors. So let's start with the newsletter writers. Now, keep in mind, this comes out Tuesday night, but it is based on newsletters that have been written through the previous Saturday. So we wouldn't have included the couple big up days that we had this week. But the bulls advanced to 53.5 from 50% a week ago. Sometimes trading tops, somewhere between, sometimes you get trading tops for like pullbacks when you get to about 55%. So we're approaching that. We're not quite there yet. If we get to 60%, then you start worrying a little bit more. Just to put it into perspective, you know, we were at 59.4% before in the beginning of this year. So we were a little elevated, and then of course, you know what happened, but I don't think that was necessarily due to sentiment. The bears didn't change at all at 23.7. That is the fewest, though, since the first week of March. And then the bull bear difference expanded to 29.8. So caution is at around 30%, so we're almost there. But action, often you take a little off the table when that gets to 40% historically. So we're not, you know, we're getting up there, but we're not at huge danger levels yet. And then for smart money, dumb money, this is from Sentiment Trader. Liz Ann looks at this, so I look at this. 52 smart, 71 dumb. So that is switched. So again, suggesting it's not, the spread is not enough to be totally actionable, but it is showing a little bit of, you know, getting to a little frothy, but it's not quite there yet. So we probably need another rally to make them go to danger levels. And then, interestingly, though, Ma and Pa investors still are not convinced. This is as of Wednesday night, which does include this week, the big days this week. It didn't really move the bulls that much. They only went up by 1.5% to 34.6. When you look at those numbers, you got to compare them to the historical average, which is 38% bulls. And the bears are at 38.9%, so they decreased by 3%. The other part that didn't go to the bulls went to the neutral area, but the bears rather are still above the historical average. They're basically 39 and the historical average is 30. So by that measure, it's not yet frothy enough. So we're getting there, but again, not quite there yet on the summit. All right. Let's take a look at the NASDAQ composite, and then we'll take a look at the Qs, NASDAQ 100. So we did manage to break through that minor resistance area. It's not surprising that we might at all-time highs here. We might not take a little bit of a pause if we get there. Uh, I'd say support is between the 10-day moving average and those previous highs. So somewhere between, what's that, 94.60 to
Yeah.
95.50, kind of in there, I would say. You see anything else there, Mike?
No, I agree. I was just looking at that 10-day moving average there. Yeah, so that's the area I'd be looking at, and that also is pretty much where if we drew a trend line from those lows there as well too. That's about exactly where that comes in as well too. So around that 90, I'd say around the 95. I'd be careful below 95. Want
Yeah,
to see it hold 95.
yeah. Now let's look at the Qs.
They made an I don't know if the Q's made a new high, but I know the 100 made a new high today. Yep, they did.
Yeah, they did. They just intraday made a new high. It's not a new, wouldn't be a new closing high today.
Right, right.
But again, you would suspect a little bit of a pause the first time you go up to an all-time high. I mean, generally speaking, the first attempt at a major resistance, you need a couple of times to try to get
Right.
through it. So that, again, if you're trying to manage positions, depending on your time frame, you could use either the 10 or 20-day moving average. 10 is the yellow line, and the 20-day where we bought it right up, and see, was the 20-day, which is the orange line. Now, we had a question on the IWM, which is the Russell, so we'll take a look at that. You got the 200-day looming there. I'll take off the Fibonacci's here. You got some support at the rising 10-day moving average, but you got the 200 there. So again, probably that's a pretty major level. So if you get up there, maybe you would lighten up just a little bit with the eye of if it does break through it, you add it back. But we're getting to a point where maybe you take a little bit off the table. What do you think?
I think you're right. Yeah. Also notice that the RSI is just hovering just below that 70 level as well too. So and it's maybe a little bit of a turn down. So yeah, I think it kind of fits a lot of these other markets here where we've hit some significant resistance levels and maybe a little pullback is in order. Though I will say though that the IWM and the Russell there is outperforming both the Nasdaq and S&Ps today. So maybe a little bit of that money taken out of the Nasdaq there as it made new highs, and maybe some of it's going into the Russell. That's why it's probably performing not as badly as some of its compadres today.
Yeah, also I think the rise in the 10-year
Helps a lot of banks, yeah, the
yeah,
financials.
there's a lot of regional banks in the
Yep.
Russell, so maybe that's it as well. Let's see. Let's look at sector action. Let's just look at the ones we've been following, and then we'll see what today's action is. We've been following the home builders, which we've told you about for a while. Nothing wrong with that chart.
No.
So, you know, use the 200-day to set a stop in the short term. But we've told you about this one for a while. Probably we got a little bit of pullback in the metals. Let's take a look at the gold miners. They're up a little bit. They're trying to hold. I should really move this support level down now because we've got two tails there.
Right.
So I think right there at about 32.40 is where you might want to manage your risk. You can see I drew in perhaps a little bit of a head and shoulders there, but it hasn't triggered yet. If gold goes into a trading range, this will probably go into a trading range, I would think. Let's take a look at the silver miners. What did I do there?
Nope.
Ah! Oh no!
We're gonna do Delatheria instead.
Oh no!
Got a
I
mind of
wiped
its
out.
own. That AI is taking over, Lee.
It has been. Geez. So I got to get another chart up here so we can. I just wiped out my tab, is what I did. So let's take a look at the silver miners. Zoom in here. Yeah, so There's the key level on the silver miners. If you are involved with them, it'd be about 33.5. Let's see. And then we were looking at energy. Again, this is a
Yeah,
place where you might get some profit taking, right? We filled the
right.
gap, but let's put up the moving averages here. I've got to do it by hand now because I wiped out my
Old school here.
old school. You gotta. So we'll do the.
See, it's a teaching lesson. How do you add moving averages to your charts?
Yeah, you don't do what I'm doing. Here we go. So let's put up to 200. Yeah, that's pretty far away. If you want to put on more than one, it's easier just to do it through the study. So let's put on the 50 and the 20 also. So we'll do that. We'll make the 20 orange and we'll pull in the 50 and we'll make that our usual purple. All right, so 20 looks pretty good as a way to trail a stop. But again, when you get up to major resistance the first time, it is not the worst idea to take a little off. Not everything because the trend is up, but there you go. All right, let's see. Those are the ones we've been looking at. So let's look at the biotechs. So key level there. I think you're okay as long as it holds 128 on this one. The XBI key level there is 99-ish. And there you can see that's major. If we put on the, that's a major level right there. And then let us go and take a look now at, oh no, I can't do that because I wiped out that tab. Let me load up again here, just a second. I don't want to have to rebuild that list.
Yeah, well, while we were looking at those two charts, the biotechs, to me, I mean, if you look at, even though the kind of consolidation, they really have kind of broken the uptrend line that we've seen from the lows as well too. So they're kind of looking maybe a little heavy at these levels. So I wouldn't be surprised if we start to see, maybe a little bit of money being taken out of those formerly pretty strong sectors and seeing some money fall into some of the ones that may have been maybe finding a little new upward momentum. So we'll have to kind of see if that actually plays out.
Yeah, so Mark is asking, this is a teaching moment if you have a fat finger like I just did. Yeah, if you knocked out your charts and what I do is, before I log off every time, I save my layouts to the cloud at the Schwab server. And how I got this back, I just went to load, and this is the one that I use here, and then it pulled it back. So that is how I recover from an accidental deletion. It only takes, how long did it take?
Yeah, 2 minutes.
Two
Tops.
minutes.
Yep.
Yeah. So what's moving today, obviously, is
Airline.
the airlines. So let's take a look at that. We talked about this on Trader Talk.
Right. Now that's the one where you're seeing a lot of investor inflow into the Jets ETF, right? I've been hearing.
Yeah. Look at this. Yeah, and the fund flows are pretty good in this. So you got, depending on how much risk you want to take, you got good levels there. The first level is 18, and the one below that is 16. So that, maybe this one will catch up a little bit. So there's something you could watch. Let's see what else is moving here. Oil service is
Oil
moving today.
service.
Yeah, let's take a look. Seems like it's going to fill the gap. But again, then you'd have to, if you are long already, again, maybe take a little off the table. See what else is moving. The junior gold miners. Junior gold. These are the smaller cap ones. Take a look at those. Now, it kind of looks like the big ones. Again, we already talked about this, but there's your key level on this one. 43.89. Kind of surprised they're up, given that gold's not doing too much.
Yeah, it's up, but like I said, it's actually outperforming, gold today. So it's kind of
Yeah.
interesting. So
Yeah.
so what's lagging today, Lee? I always like to look at the
Laggards? Yeah, let's take a look at
the laggards.
what is not doing well today. We'll just reverse this. Yeah, so they're taking a little profits on the one that have moved, right?
Yep.
The cloud stocks have been on fire. So looks like people were taking a little bit of profit there. Let's take a look at these. Yeah, but it's still a wonderful chart. Just a little profit taking. Now, if you're bold, you got to pull back right to the 10-day here.
Yeah, I could think that's gonna hold the trend, then yeah, maybe there's a place to pick some up for a short-term trade.
Yeah, so pick a little here. If it breaks that, but holds 1925, you could buy a little more. But then, of course, if it takes out that level, you got to get out of the position. But so a little profit taking, because that one has been a huge mover. Let's see what else is not moving today. Yeah, cloud, 3D printing. So all of the kind of, stocks that have been on a tear, like software,
Healthcare.
all those. So they're rotating a little. It feels like they're rotating a little bit. We just pulled back to the 10-day here. He's giving you a possible short-term entry right there. And then let's take a look at the financials. They were on a tear. They still are on a tear. So you're getting a little bit of rotation into the values today, a little bit.
And it looks like also filled in that chart gap there from that March 9th.
Yeah. So watch the 10-day moving average with that one. Okay, let's see. Let us take a look at what else might be moving. Let's see. What I also saw was we talked about the home builders. Also, it looks like the mortgage REITs are getting a little bit of a bid, which would make sense. Let's take a look at them. Yeah, see, this is a nice breakout happening right there. We mentioned it yesterday, and this might be a place to take a look for a trade on the bullish side. Maybe. We don't give recommendations, but there you go. And our time is up. Coming up next, 8 stock selection myths with fellow Chicago native there, senior quantitative analyst from our Schwab Equity Ratings Department, Adam Lynch. And then also there's going to be some introduction to futures trading today as well. So if you liked what Mike was talking about, but you don't know very much about futures, you might want to take a look at that one.